Ever wondered what the difference between value and growth stocks is? Well, let's unravel that mystery today. In the financial world, stocks are not all created equal. They fall into different categories, and two of the most talked about are value and growth stocks. Value stocks are shares in companies that the market undervalues. These stocks are often likened to hidden gems waiting to be discovered. They belong to companies whose current net worth, when you crunch the numbers using indicators like price to earnings, PE, and price to book, PB ratios, is higher than their market value. Think of companies like Procter & Gamble and Pfizer. On the flip side, we have growth stocks. These belong to companies anticipated to grow at an above-average rate compared to other market players. They are the high flyers, the trailblazers, the companies that are expected to outperform. Think Netflix or Amazon. In the next few minutes, we'll delve into the key differences between these two types of investments, using a few metrics. So, how do we identify value stocks? An excellent question and one we're about to answer. Value stocks can be spotted using few key financial ratios, primarily the price to earnings, PE, price to book, PB, and dividend yield ratios. Typically, a value stock will have a lower PE ratio. This suggests that the company's earnings are high relative to its stock price. Similarly, the PB ratio, which compares a company's book value, or net assets, to its share price, is also usually lower for value stocks. This implies the company's tangible assets are high compared to its stock price. On the flip side, value stocks often have a higher dividend yield. This means they distribute a significant portion of their earnings back to shareholders. Let's take Procter & Gamble and Pfizer as examples. These companies consistently exhibit lower PE and PB ratios and higher dividend yields, classifying them as value stocks. Now that we know how to identify value stocks, let's move on to growth stocks. What about growth stocks? How do we identify them? Well, the identification of growth stocks is slightly different from value stocks. Growth stocks are typically associated with high-profile, innovative companies that are expected to grow at an above-average rate compared to other companies in the market. The first point to consider is the price-to-earnings ratio, or PE. Growth stocks often have higher PE ratios as investors are willing to pay a premium today for expected future earnings growth. Think about companies like Amazon and Netflix. The price-to-book ratio, or PB, is another key metric. Growth companies often have high PB ratios as their market value tends to outstrip their book value due to expected future profits. Lastly, dividends. Unlike value stocks, growth stocks usually don't pay dividends. Why? Because they prefer to reinvest profits back into the business to fuel further growth. Having explored both value and growth stocks, let's conclude with a summary of the key points. In this journey of understanding value and growth stocks, we've covered some ground. So let's quickly recap. Value stocks like Procter & Gamble and Pfizer are those that are typically underpriced relative to their intrinsic value. They're identifiable by their low price-to-earnings and price-to-book ratios and high dividend yield. These stocks are often seen as safer investments, offering steady, albeit slower growth and regular dividends. On the other hand, growth stocks such as Netflix and Amazon are usually overpriced, and their value lies in their potential for rapid growth. These stocks are characterized by high PE and PB ratios and often do not pay dividends, as they reinvest earnings back into the business for expansion. The risk is higher, but so is the potential for substantial returns. The choice between value and growth stocks ultimately depends on your risk tolerance, investment goals, and time horizon. Now, you're equipped with the knowledge to distinguish between value and growth stocks, a tool that can prove invaluable in your investment journey. Until next time, keep investing smart.